Personal finance isn't about freedom, it's about control. And most people don't control their money controls them. In a country carrying $18.59 trillion in household debt, that isn't random. You were trained to earn, not to understand the structure you're earning inside. The mainstream playbook sounds clean. Follow the 50-30-20 split, build a 3 to 12-month safety net, invest steadily, max the employer 401k match, avoid bad debt, retire fine. On paper, it's rational. In reality, it assumes stable income, predictable expenses, affordable healthcare, and the emotional ability to ignore market swings. But wages move slowly, while asset prices compound faster. Inflation quietly taxes idle cash. Credit card balances, now above $1.23 trillion, generate profit when people carry interest, not when they pay in full. Student loans sit around $1.65 trillion. Mortgages exceed $13 trillion. Debt isn't a glitch in the system, it's revenue inside it. So if budgeting apps, investing podcasts, and financial education are everywhere, why do smart people still feel behind? Because information doesn't override incentives, and discipline without margin feels like running uphill.
The 5 pillars: income, spending, saving, investing, protection, look neutral. They're not. Income for most people means wages, trading time for pay with limited leverage. Income for asset holders means equity, yield, and appreciation. Same economy, different positioning. Spending isn't random either. It's engineered through frictionless payments, rewards programs, and subscription convenience. Saving is praised, but cash loses purchasing power if inflation outpaces interest, forcing you into a tension between safety and growth. Investing works over long horizons. Compounding is real, but only if you can tolerate volatility without needing to liquidate. Risk tolerance isn't personality, it's position. Someone with 6 months of reserves sees a 30% market drop as noise. Someone living paycheck to paycheck sees danger. A graduate with $40,000 in loans, splitting income between repayment and a Roth IRA, feels responsible, yet stretched. A new homeowner at 7% interest builds equity while absorbing concentrated risk, rising taxes, insurance, repairs. The rules increase probability over time, but they don't erase layoffs, medical shocks, rent hikes, or uneven starting lines. The model breaks when we treat probability as guarantee and behavior as the only variable.
The upgrade is this. Stop viewing personal finance as a list of tips and start seeing it as positioning inside money flows. Money moves from labor to institutions, from borrowers to lenders, from consumers to shareholders. The question isn't whether the system is fair, it's where you stand within it. Are you mainly paying interest or gradually collecting yield? Are you exposed to risk without cushion or insulated by reserves? Personal finance isn't a morality test, it's leverage management. The aim isn't aesthetic wealth or perfect optimization, it's margin. Margin in cash, skills, optionality, and time. That means understanding trade-offs clearly. Debt can accelerate ownership, but is priced. Credit cards can build a score, but are engineered to tempt. A 401k match is free money only if you can afford deferral. Insurance feels costly until it prevents catastrophe. When you see the mechanics, shame fades and strategy sharpens. You stop chasing optics and start building resilience before upside. The system will continue rewarding disciplined capital and ownership. The unresolved question is how long you plan to remain on only one side of that equation.